Vietnam's banking sector just delivered another year of double-digit earnings growth, with ROE staying close to 18%, well above most regional peers. But what's more interesting is how that growth is starting to change, and why the recent correction may be creating a more attractive entry point. Looking back at 2025, the sector delivered another year of solid performance. Pre-tax profit among the 15 largest banks grew around 15.3%, while ROE remained at 17.6%, well above the 9 to 11% range seen across most regional markets. What stands out is that this was not just a credit-driven story. Asset quality continued to improve. Bad debt recovery accelerated by 45.8% year-on-year, and fee income became more diversified as banks expanded into insurance, securities, and wealth management. At the same time, digitalization quietly improved productivity and operating efficiency across the system. Heading into 2026, earning growth is still expected at around 15.9%, but the nature of that growth is changing. Higher interest rates and tighter regulatory guidance will likely moderate part of the demand that was previously supported by accommodative conditions. However, this also creates a more rational environment, with reduced competition helping to stabilize margins. At the same time, following the recent correction, valuations have reset to more attractive levels while structural drivers remain intact. In our view, this is where the sector starts to look increasingly interesting from an investment perspective. The strong earnings in 2025 were supported by credit expansion. System-wide lending grew 19%, the fastest pace in 5 years, backed by a favorable macro backdrop including 8% GDP growth, while retail sales and industrial production both rose 9.2%. Public investment also surged nearly 37.7%, reinforcing financing demand across the economy. Within this environment, corporate lending remained the main driver, supported by infrastructure development, FDI-led manufacturing expansion, capital market activity, and the gradual recovery of the real estate sector. Retail lending only started to regain momentum later in the year, particularly in mortgages, auto loans, and consumer finance, alongside early growth in unsecured lending, supported by better data analytics. Going into 2026, this pace is expected to normalize. Regulators are guiding credit growth closer to 15% and increasing oversight on real estate lending, while higher interest rates are likely to temper demand in more speculative segments. That said, a more disciplined credit environment should reduce aggressive competition, support lending yields, and improve overall underwriting quality across the system. Over the past few years, including 2025, system liquidity has remained relatively tight as credit growth outpaced deposit growth. This pushed loan-to-deposit ratios higher and increased competition for funding. External pressures made this more challenging. An unfavorable USD-VND interest rate differential led to capital outflows and more frequent FX intervention, effectively withdrawing liquidity from the system. At the same time, households shifted savings toward alternative assets such as gold and foreign currency, slowing deposit growth. However, this dynamic is now beginning to shift. USD interest rates declined by around 75 basis points in 2025, while domestic rates have risen by approximately 250 to 300 basis points over the past 6 months, making the interest rate differential more supportive. Combined with structural inflows from FDI, tourism recovery, and the potential market upgrade, together with liquidity returning through accelerating public investment, funding conditions are expected to gradually improve even in a higher rate environment. The sector's net interest margin declined sharply in 2025 from 3.6% to 3.2%, reflecting the divergence between lending yields and funding costs. Lending rates softened earlier in the year as banks responded to regulatory guidance aimed at lowering borrowing costs to support economic activity, while competition for high-quality borrowers intensified. Meanwhile, funding costs began to rise from early second half of 2025 as banks stepped up deposit mobilization to support the rapid pace of credit expansion. However, margin dynamics began to shift toward the end of the year and could become more supportive going forward. Lending rates started to reprice upward from the fourth quarter of 2025 amid tightening system liquidity and a gradual normalization of loan pricing. Looking ahead, more disciplined credit quotas would ease competition for lending, while the rising share of medium and long-term loans should help support lending yields and gradually stabilize net interest margin. On asset quality, the picture remains relatively reassuring. Non-performing loan ratios stayed stable at around 1.8%, while warning indicators such as Group 2 loans declined, indicating slower formation of potential problem loans. At the same time, bad debt recovery income surged 45.8% year-on-year, supported by stronger macro conditions and a recovering real estate market. Regulatory improvements also enhanced the efficiency of collateral resolution. Looking ahead, asset quality may face some pressure in a rising interest rate environment and under stricter oversight of real estate lending. However, current interest rate levels remain broadly within the range observed during the pre-COVID period, when borrower repayment capacity across most sectors remained relatively stable. With a more cautious lending approach, any deterioration is expected to remain manageable rather than becoming a systemic concern. Beyond traditional lending, the structure of bank income is gradually evolving. In 2025, fee income continued to expand, supported by a recovery in bancassurance and strong momentum in investment banking activities such as bond underwriting and corporate advisory. At the same time, new digital revenue streams, including banking as a service, are emerging. More importantly, leading private banks are increasingly developing integrated financial ecosystems that combine banking, insurance, securities, asset management, and digital platforms. This shift comes at a time when Vietnam's GDP per capita has surpassed $5,000, a stage typically associated with rising wealth accumulation and increasing financial participation. As these ecosystems expand, banks are able to capture a larger share of customer financial activity, supporting more diversified income streams, stronger customer retention, and improved low-cost funding through demand deposits. Operating efficiency is also improving in a more structural way. Banks continue to invest heavily in digital infrastructure, including AI, data analytics, and automation, which help streamline underwriting, enhance risk management, and improve customer targeting. At the same time, open banking platforms are enabling deeper integration with fintech and corporate partners, transforming the sector toward a more scalable, ecosystem-driven model. As a result, cost efficiency continues to improve, with the sector's cost-to-income ratio expected to decline further to around 30.3% in 2026. In 2025, several regulatory reforms were introduced to strengthen Vietnam's banking system and financial market infrastructure. Changes to collateral seizure rights and legal protections have improved banks' ability to resolve distressed assets, accelerating bad debt recovery and supporting balance sheet liquidity. At the same time, regulators outlined a roadmap toward Basel III, enhancing capital transparency and risk management in line with international standards. Measures to ease foreign investor access, including simplified account opening and reduced administrative barriers, further support capital market integration and reinforce Vietnam's case for a potential FTSE secondary emerging market upgrade in September 2026. From an investment perspective, the recent correction has started to create a more compelling entry point. After a strong rally in 2025, bank stocks have pulled back over the past 6 months amid profit-taking and rising global uncertainty, bringing valuations down to around 1.2 times PB and 7.4 times PE for 2026, levels that are more in line with historical averages and offer a clearer margin of safety. Within the sector, private banks remain the more compelling growth story. Their stronger execution in digital transformation, broader exposure to higher-yielding segments, and ability to build integrated financial ecosystems position them to outgrow the system over time. Yet despite this, they continue to trade at roughly a 20% discount to state-owned peers. For investors seeking exposure to Vietnam's structural banking growth story, private banks offer a compelling combination of strong earnings potential, improving operating efficiency, and more attractive valuations. We therefore retain buy recommendations on selected leading private banks with strong balance sheets and sustainable growth profiles.